China or India, how to invest in the coming Asia boom. Money managers are navigating a historic shift. India's population at 1.43 billion edged past China's this year. Now the world's most populous country, India could experience a decade-long investment boom. Goldman Sachs Group Incorporation analysts expect its share of global equity market capitalization to quadruple between now and 2075, reaching 12% when it will be neck and neck with China's. Over the same period, the U.S. share is projected to drop by half to 20%. Now, India and China both offer investors a chance to profit from rising power's economic growth. China is the world's second largest economy, featuring a massive consumer market and advanced manufacturing. India has friendly relations with the West and a young workforce. Its economy is expected to grow 6% to 7% a year, outpacing China's. Its bottom middle class will be spending well beyond essentials. Conrad Saldanha, a portfolio manager focusing on emerging market equity at Neuberger Berman, says India will benefit as companies look for manufacturing alternatives to China. India is probably singularly one of the best structural growth stories globally, he says. For Sukumar Raja, a director of portfolio management at Franklin Templeton, India's increased consumer spending, including on premium products, will open up new investment opportunities. But Hughes Rallen, Chief Investment Officer for Asia at Pictet Wealth Management, says Indian stocks are expensive. The country's equity benchmark have gained in every single year from 2016 through 2022. Over the next 12 to 24 months, we prefer China, given that we expect the economy to re-accelerate and its equity valuation are low today, he says. While it's not necessarily a binary choice, investors are increasingly comparing the two giant Asian markets as they decide where to place bets. Interviews were conducted in June and have been edited for clarity and length, with John Chang, Ji Yan Lee, Ishika Mukherjee, Hideyuki Sono, and Yijing Shen, amongst others. Mark Mobius, partner and co-founder of Mobius Capital Partners Dubai, has this to say. Over the long term, India's macro factors are more favorable because of demographics as well as specific companies' growth prospects. Picking stocks in India is all about technology and digitization. We like APL Apollo Tools Limited, whose steel structures are used to construct buildings, and Metropolis Healthcare Limited, a medical testing firm. We also like software company Persistent System Limited and digital mapping company CE Info System Limited, as well as Dreamforce Services Limited, which offers services at airports. China will not achieve the high growth of the past, and thus opportunities will be limited. Nevertheless, it is an enormous market, and there will certainly be pockets of opportunities. Michael O, portfolio manager, Matthews Asia, San Francisco, has this to add too. We are overweight with both markets. This is not a zero-sum game. Demographically, India is in a better place. However, given the size of the Chinese market, it remains very important. For India, like banks, as consumers still lack basic financial services, ICICI Bank Limited is well positioned to benefit. I would avoid state-owned enterprises in general and focus on privately owned businesses. I am not too worried about China's aging population yet, since it can still improve productivity and income levels. If gross domestic product per capita can grow from around $10,000 to $12,000 currently to $20,000 to $30,000, there will be tremendous growth. Top Chinese stocks picks are KE Holdings Incorporation, which handles housing transactions and services, and Trip.com Group Limited, an online travel agency. Irene Dasani, Managing Director, Goldman Sachs Asset Management Singapore, has this to add. Both markets will follow their own dynamics. Investors may rotate from one market to the other, but over time, both should do well. India for us is a long duration, stronger for longer kind of growth story. It's one of those markets which gives a combination of three critical things: scale, growth, and profitability. China was all about export, infrastructure, and real estate. Going forward, it will focus more on domestic consumption as the next growth driver. We certainly believe there is a lot of pent-up savings and demand. As of the end of May, top China holdings in Goldman Sachs emerging market equity portfolio included Tencent Holdings and Alibaba Group Holdings, the nation's two largest internet companies, as well as liquor maker Kweichow Moutai, according to data compiled by Bloomberg. Hayaz Ibrahim, emerging market and Asia Pacific equities portfolio manager, JP Morgan Asset Management, Hong Kong, has this to add as well. Fundamentally, we like both market, but over the next year or so, purely on valuation, we have a bit of preferences for China. We like the theme of industrial upgrade and companies that have moved up the value chain. We see companies in healthcare as well as renewable energy that are embracing new technology to evolve. In India, we favor the financials, especially the private banks and issuers. The economy is growing strongly, and expanding middle class will continue to increase demand for financial products and services. The other area we like is the consumer sector due to a growing population and a higher spending power. Top holdings in the JP Morgan India Fund as of May 31 were Financials ICICI Bank and Housing Development Finance Corp, as well as Infosys, an information technology company. Cecilia Chan, Chief Investment Officer for Asia Pacific, HSBC Asset Management Hong Kong, has this to add. India will be a bright spot because of its booming population, growing affluence, structural reforms, and good policy mix. We particularly favor the real estate sector, where there's improving affordability, strong demand, robust launches and sales. We also like the financial sector, especially the largest private banks. As of May 31, top holders in HSBC's Indian equity portfolio included HDFC Bank and ICICI Bank, as well as conglomerate Reliance Industries. As China ages, technology has the potential to enhance the quality of life. We favor communication services, information technology, and industry, and also find opportunities in state-owned enterprises. As of May 31, top holdings for HSBC's Chinese stock portfolio included Tencent, Alibaba, and online gaming company NetEase, Jason Pitcock, investment manager for Asia Equity Income, Jupiter Asset Management, London. India's huge young population is a powerful driver of growth. While still a developing country, there is no doubt India is in many respects a cutting-edge digital economy. We think the consumer, financials, and utility sectors will benefit the most from India's demographic dividend, but you have to be very selective within them. As of May 31, the top holding for Jupiter Asia Pacific Income Fund was Indian cigarette maker ITC Limited. We own no mainland Chinese companies. The geopolitical tension between China and not just the US, but also Japan, South Korea, and Europe are likely to increase in the coming years. We don't favor the domestic situation with the government taking a greater influence over the likes of Tencent and Alibaba.